So welcome to Mindful Money's seminar. We're on Zoom and live on Facebook chat. So you can participate in the discussion either through putting comments into Zoom chat box, or you can put it into the comments on live. Facebook Live. So feel free to do that. It'd be great if you enter stuff in there as we go along. So we'll have a decent period for Q&A at the end of the session. I think we're probably ready to go. I'd like to extend a warm welcome to our guests for this week. As many of you know, that this is a series of Mindful Money's doing. We're doing 10 seminars, one each week, all of them at 4 p.m. on Thursday. And this week, it's my great pleasure to welcome Andrew Lance. Andrew is the Chief Investment Officer for Simplicity. Simplicity doesn't need much introduction. I asked Andrew for what he wanted to say about him, and he said that he'd been in Simplicity since the start, since it was set up, and he has worked previously with Sam Stubbs, and he's back for more. So well done, Andrew, and it's great that you've come to join us. And Simplicity has been such a disruptor in the KiwiSaver space. You guys have had massive growth, and it's terrific that you're along here and talking to us about this. So thank you.
No, not at all. It's great to be here. Thank you.
Cool. Without further ado, what we're going to do is Andrew and I are going to talk for about 15 minutes or so, and then we'll open up to Q&A. And we're going to make everything sort of fairly short and sharp, and because we're in lockdown online world, and I'm sure everyone's really busy with 1,001 other things to do, or not. So Andrew, can we start off, if you could just give us some background on Simplicity's model for operating. You decided to set up as a obviously low fee passive provider, but also with a strong ethical bent. Can you give us some background?
Sure, and I'll keep it as brief as I can. But in a way, it all stems from Sam. He was very much the founder of this, and it was something he started thinking about not long after he left corporate world back in 2013. He started working his way through. He tried various charitable ventures and was trying to work out how he could really make a difference to the financial markets, financial system. And after a little bit of evolution, we ended up with the idea of a not-for-profit KiwiSaver scheme. The idea being, and his motivation and our motivation now, is very much to try and give everybody more dignity in retirement. That's our target. And in order to do that, he deemed the best way was to put more money in people's pockets, to give them more choices when they retire. And at the same time, he came from very much a philosophical view that passive investing was the way to go. Keeping your fees down to an absolute minimum bettered the chances of us giving that choices outcome, because active management is expensive, and you can argue this, and it's the subject of much debate in the industry, but there's plenty of studies that suggest passive will outperform active over a long period of time, and KiwiSaver is a long-term investment. So when we started out in 2016, we immediately adopted, very soon after we started, we adopted a new fund by Vanguard, which excluded just nuclear weapons, controversial weapons, and fossil fuels. And then back in 2018, we extended that exclusion to include alcohol, tobacco, gambling, civilian firearms, military weapons, pornography. I've forgotten one, but I think I've got them all, and nuclear weapons still. And so that exclusions, we've adopted a product called the Ethically Conscious Fund by Vanguard, and so that's our approach to ethical investing, socially responsible investing, is to exclude industries rather than spend a lot of time and effort finding, if you like, finding the good stocks. At the moment, we are just trying to exclude the bad stocks.
Okay, good. So I wanted to pick up on this whole thing of investing ethically, and I've got a slide that I'll bring up. So on this, let me just make it to a large size. One sec. So here we go. So we did an analysis of investing during COVID-19, and we found that the KiwiSaver funds, the ethical KiwiSaver funds on Mindful Money's website, had done significantly better than the average. And you can see in the categories here we have conservative, balanced, and growth, and particularly for the growth funds, the mindful funds, including Simplicity, had significantly outperformed the sector average. Now, this actually reflects international experience. There's been a number of studies, and a new one came out today about international funds, international ethical funds, but also it reflects a longer time frame for the way that ethical funds do well financially, as well as doing well ethically. So, Andrew, can you talk us through what happened as you've gone ethically with Simplicity? And I recall some analysis that you did to compare the unscreened and the screened versions.
Yeah, thank you. And to be honest, I've got to preface everything with the requirement is that we're always acting in the best interest of our investors. And so that was the reason when we moved to this greater exclusions back in October 2018, the data supported the idea that this fund would outperform the unscreened version, but we didn't really expect it to be quite as dramatic as it's been since. So since we moved from the partially screened version to the fully screened version that we've got now, the outperformance has been about 2%. So from October 2018 to 31st March this year, about 2%, just over. But the vast majority of that has come in the last quarter. In the last quarter, you compare the two different funds, our exclusions fund has outperformed the unscreened version by 3.75%, 3.75%, which is phenomenal. Now, this is just the international shares sector, but in our international bond sector, which tends to be far more conservative, the outperformance is only 0.3. So it very much mirrors that chart you just showed, Barry, that the growth-orientated funds that are excluding the likes of fossil fuels have done considerably better than those that are invested in the traditional industry sectors.
Cool. So thank you for that. So Andrew, obviously your ability to run these passive funds and run them as ethical funds depends on what these big passive funds do. And Simplicity uses Vanguard as a fund supplier. So what influence do you have over those kind of big funds?
It's been really interesting because just as we started business back in 2016, everybody I suspect will remember that I think it was Radio New Zealand came out with it first, was this sudden expose that all these KiwiSaver schemes had nuclear weapons in their investments. And that was just at the point that we were getting going. So we got in touch with Vanguard and said, look, we can't have these in our portfolio. And they were obviously mirroring the sort of input they were getting from elsewhere. So we got our originally screened film, and then over time we've continued that discussion, and they've launched their exclusions series. Now, we're not claiming at all to be the people that have gotten to do this, but we are one voice in there. And the area which is frustrating, or has been frustrating us up until now, is the Australian share market, where we can't find a decent index fund that screens out the type of industries that we don't want to invest in. And we've been in discussion with Vanguard on this, and they've now come to the party. So we're not there quite yet, but we're pretty comfortable that within a month or two we will have an exclusions version of the Australian share market, which will get rid of those ones that are troubling us that are in your database. But I think the mere fact that they've now come to the party on this is just a recognition that we've got some influence on them, but most of all that there is gradually, even in Australia, a greater need for these sort of funds.
So while we're on the subject, Mark Smith just asked a question in the chat room. According to the Mindful Money website, we list what's in the fund portfolios for every KiwiSaver fund. He points out that Simplicity's Balance Fund still has 1% of its assets invested in fossil fuels. That's presumably to do with the Australian fund issue that is going to change as Vanguard offers a better alternative, right?
That's right. That's right. It's frustrated us. We've liked to have said that we've got no fossil fuel investments, but we haven't been able to up to now. Not totally because of the Australian influence. I mean, and at this stage, it's quite explicitly explorers and people with fossil fuel reserves that we're excluding. We're going to extend that exclusion shortly, and that's going to include some of the downstream providers to these fund companies as well. So the new Australian version will actually exclude more, and then that will be moved out to our international share fund as well.
Very good idea to exclude fossil fuels. I had a look at the data the other day, and oil and gas index down by 50% over the past 5 years. Coal down an average of 28% per year for the last decade. The warnings have been out there about fossil fuels being a really bad investment and likely to end up in stranded assets. How much of your good performance of your ethical funds do you think has been because you're out of almost all of the fossil fuels?
I've been trying to get some of the detail out of Vanguard on that, and it's quite encouraging because it's not just the fossil fuels that have hit it. That was about 1% of our outperformance. The weapon sector was another 40 basis points, 0.4% of the outperformance that we don't hold them. But also, and very important to get, it's again gets a bit technical, but if you're an index investor, you've got to replace what you're excluding with something else. And the index provider, which in this case is an entity called FTSE, they have to decide how to create an index which still has the positive aspects of the world share market, but it excludes the industries we don't like. And so what we found is that we're relative to the unscreened index, we're actually overweight the likes of software and services and so on, and that was a positive. IT overall was positive, and the healthcare sector also is one that we are overweight relative to the unscreened universe. So, which again was very positive for return. So you can't just exclude stuff; you've got to replace it with something else. And for us, that's been positive as well.
Cool. If I'm one of the fund managers for an actively managed funds, one of the things that they say gives them an advantage is that they're able to screen out sort of bad companies that may not belong to a whole sector. So you're screening out gambling and tobacco and fossil fuels, etc. But there are also sort of companies that operate across lots of sectors that do bad things, like human rights violations or test products on animals. Do you see a day when the passive funds that you invest in are going to be able to screen out some of the companies that do bad things as opposed to screening out whole sectors?
Well, again, it's an area that we're working with Vanguard on, and they're working with the index provider on, because there is gradually more and more research coming through, which would allow you to again negatively screen for companies that appear on lists, if you like. And we're working on them using the UN Global Compact, which is a series of principles companies are supposed to adhere to, and they call them controversies. So basically, if somebody is in the news for not having adhered to one of these principles, then that too will be a reason for it being excluded from our fund. So things like human rights, anti-corruption, the environment, labour laws, diversity, actually you can screen for those. It's not as perfect as doing the research yourself, accept that. But again, we come back to, from our point of view, trying to deliver our investors the best possible returns over time. We believe this by charging the least fees we possibly can. And that is therefore using a sort of an index approach rather than actively managing.
Yeah. For those in the audience, if you haven't been to the Mindful Money website, we've got some categories like human rights violations, products tested on animals, that are not whole sectoral exclusions. So we've gone through that process of generating those lists. By the way, everyone, we're coming up to question time, so get going on your questions in the chat, and those of you on Facebook Live, please enter any questions in the comments, and we'll respond to those as well. I'm here with Andrew Lance. Andrew's the Chief Investment Officer for Simplicity. Andrew, without giving away your secrets, Simplicity's been a great disruptor of KiwiSaver markets. So, what do you got coming up?
I won't say anything too disparaging about what Sam's likely to do. He's always a little bit unpredictable in these things. But from our point of view, again, going back to our reason for being, we just want to continually reduce our fees, give as much money back to our investors as we can. We are giving 15% of our revenue to charity, as everybody knows, and that's great too. That's been tremendous too, particularly in the last couple of months, being able to support charities on the front line. But again, yeah, and if Sam were to get his the utopia in all this, we get our fees down to a point that it's virtually zero, and that if we can get the scale, we'll just continue to give that money back to our investors.
Cool. I noticed, and talking to Sam, you guys have added a component of some funding for venture capital. They're in New Zealand, good New Zealand startup companies. Is that going to be a larger component of what you do, or you'll probably have to keep it to a fairly small niche activity?
Yeah, I mean, again, if we can get some scale, even if it's niche within our portfolios, it will become significant. We've teamed with a crowd called Icehouse. They're an interesting bunch. They've been very involved in sort of private equity funding now for many years. And we believe it's an area that we should be trying to encourage these smaller companies to come and grow. We don't want to keep missing the opportunities. So it will be, as you say, it will be a relatively limited exposure. These are long-term investments, and it's a bit difficult within something where people can actually move out and in and out of your funds without control. So we've got to be careful that it doesn't get too big. But if we can get scale, then that will still be a reasonably significant investment from a New Zealand Inc. sort of point of view. Okay.
So, question from Rose Phillips. Thanks, Rose. How's my KiwiSaver doing so well given the pandemic? Is this reflective of your ethical focus? It's a growth KiwiSaver fund. Rose apologizes for cheerleading and giving you a really soft pass on this one.
Thanks, Rose. It would be nice to say that I think it's just the ethical focus. I think that has been beneficial. Once again, as you say, Barry, we don't have the oil companies, and they've had a pretty hard time when oil gets negative. But it's, to be honest, at this stage, it's partially that global share markets are looking through the crisis. They're buoyed by the idea that companies are coming out of this already, albeit that we've retained our lockdown for a bit longer than most. Other countries are trying to get out of it. In our opinion, we're not out of the woods, but at this stage, anyway, the share market's taking a reasonably positive spin on the background news.
Cool. So Luis has asked a couple of questions. One about A2 milk. saying is not overrated, leaning too much on growth, and then secondly, for you to divulge your secrets about what industries you're looking to invest in.
Oh, I wish I had a crystal ball. We're an index investor, so yes, we do hold A2 milk, but only in the proportion that it is of the index that we follow. So we don't have, if you like, a view on sectors or industries, etc. We believe that it's right to invest ethically, for whatever that means, socially responsibly, and therefore we will continue to do that from an industry point of view, and we will continue to avoid the industries that we don't like. But in terms of which ones are going to do well out of all this, I'm afraid we're the wrong people to talk to. You should have spoken to John last week.
Yeah. So a question from Josh and one little while ago from Estelle about particular sectors that you may want to screen out. So Estelle's asking about palm oil. Should you be screening out palm oil? And Josh is kind of challenging her, but to say, shouldn't you be screening out dairy?
Dairy, goodness. And these things are, and this is where I guess I come back to, I find the idea of ethical a bit of a challenge, because everybody's ethics are different. We're trying to reflect the views of as many people as we can in the exclusions that we do. We've asked our members what sectors they would feel that we mustn't be in, and I know you, Barry, your site's done some research on this too. I haven't heard a lot on the palm oil question more recently, but I know it is controversial. At this stage, it's not on the list of things that Vanguard and FTSE are looking to exclude. But in terms of which sectors do we actively invest in, as I say, we've excluded all these industries that we don't want, and so we have to put other industries in. And the two that I know that have been beneficial to us so far, as I said before, are the healthcare sector and basic computer software and services. And again, I suspect they're doing very well in this environment, so they will continue to be beneficial for us. But we're a follower, and we're trying to keep our business as simple as we can. That's how we can keep our fees as low as we do. And so we're not going to spend our time actively trying to think these things through. We're relying on the big research going on elsewhere in the world.
So a good segue. Barbara's asked a question, sort of going up to the high level, around what impact do you think the COVID crisis is going to have on the New Zealand economy, particularly greening and sustainability of the New Zealand economy? Do you guys spend time kind of thinking of that? I know that Sam's keen on simplicity, making a contribution through investing in infrastructure, etc. What's your views on how this is going?
Yeah, I'm not sure it falls in the category of greening, but I mean, everybody, I think, now understands we're never going to be quite the same again. And in our view, it will mean that hopefully a bit more money that we've got under our management will get more focused on local issues. We're very keen. Again, we come back to that KiwiSaver is a long-term investment. There doesn't seem to us any reason why, again, if we can get some scale, if we can't have some allocation to the likes, as you say, of local infrastructure type projects that have got a 10-year time horizon, but a payback at the end of it all, a toll road or whatever. Or I mean, low-cost housing is another one which we've talked about internally as an area that there is no reason that we cannot get involved in, provided we can justify it from a returns point of view, and if we can therefore be supportive to the New Zealand economy, then great. That doesn't answer the question, but I think, as I say, my view on what we get when we come out of all this is that hopefully people will be a bit more appreciative of what they've got, if they've got. There's going to be a reshake of a lot of industries, undoubtedly. I'm naturally optimistic about stuff, and I think New Zealand's an extremely innovative type of economy, and people will find a way. But
Yeah.
I'm not sure, as I say, I can really answer on the green question.
So from the mindful money side, we've been engaged in some discussions about what kind of policies might take an advantage of this opportunity. If you kind of step back and say this is probably once in a generation pandemic, but the recovery will be once in a generation opportunity to invest for the future. And we've got to get that right, because it'll also be probably a generation to pay back the debt as a result of it. So if we don't get this right, and if we don't shape the economy for a sustainable future, then actually we've missed a huge opportunity. We might well lock in the kind of fossil fuel dependent, unsustainable economy of the past and inequitable economy of the past. And so we're kind of trying to provide some advice at the moment around how that looks, not only from financial sector policies, but more broadly. And I think it's a really good time for people to be grappling with this issue. And hopefully we'll have Kate Rayworth on the series in a few weeks' time. So she and Jonathan Porritt from the UK have been doing a lot of work around this, and we'll have some other speakers who address some of these broader issues as well. And certainly the financial sector is going to be crucial, because we have to channel funding through to the kind of economy we want. So other questions coming in, maybe we'll just take one or two more. Josh said, other sectors that don't create a kind of an ethical impact that you would like to see yourself being overweight in? And you mentioned IT and healthcare being the kind of alternatives to investing in fossil fuels and other sectors where you're underweight. Do you have any influence over that, what goes overweight when the unethical stuff goes underweight?
Generally not. I mean, within our own portfolio, we run the New Zealand Share Fund, and we exclude Sky City from that. And at this stage, we take it's called a risk approach to it, and simply replicate the Sky City holding in other pieces of the market which are appropriate. And again, it's a very small part of the overall business. We don't have a massive amount of influence on either Vanguard or FTSE, but what's really encouraging has been that they are, and Barry, this is again absolutely up your street, of course. The amount of research and the amount of time and energy that's going into ESG type funds now is such that the index providers, that's where they can see the future. So they're doing a lot more work in it. They're huge organizations. There's three main ones, and they've all got massive capacity to do work in the sector. And so we're comfortable that as this trend continues, so they'll get more and more sophisticated and doing things like we were talking before about screening out companies that hit this controversy type screen. That's new. That's very new. But it's growing in its influence very rapidly. So we don't have a particular sectors particularly. I mean, I'd love to think that we were supporting the renewable energy sector, for example, to get rid of the fossil fuels. You can think of areas that we would love to be involved with, but we are effectively a consumer of the indices. But as I say, I'm very happy that they're developing in exactly the sort of direction that we should all be happy with.
Okay. Dewey has come on to ask a question. Hi, Dewey. Thanks for your question. What separates Simplicity from the other ethical funds? So it's kind of asking you to maybe not so much make a pitch for Simplicity, but give us give everyone a sense of so how should people understand the different flavors of ethical?
From my point of view, we've had a massive competitive advantage from the day we started, and that's because we don't need to make any more money than we need to just cover our expenses. So we're not trying to make a profit. We give 15% of our revenue to charity, so you could call that, if you like, a margin. But from our point of view, that was exactly why we set ourselves up in the first place. We want to become almost an annuity for the charities that we support. So that was part of the business. But all the other, however you call it, ethical type providers, yes, they can do a great job, and I know many of them do, but they are all still trying to make money out of it. From our point of view, we're just trying to do the right thing. We're trying to give our investors as much of the money that is made out of the market as we possibly can. So it's really as simple as that. I mean, our funds are, from if you like, a performance point of view, are performing extremely well. We're right up in the top 10% of each of the categories over any extended period of time. So from our point of view, the proof is in the pudding, in a way that we're actually doing what we said we would do, and we are simply doing what everybody else is doing, but for a lot less.
Yeah. So for anyone who's online and hasn't visited the Mindful Money website, I'll make a plug. You can there see the kind of comparative analysis across funds. We set up Mindful Money because we wanted to give what we call radical transparency. We want to show people what's in the portfolios of all the KiwiSaver funds, so you can go and see every one of 270 KiwiSaver funds exactly what's in there, and then we give people a chance to look across the ethical funds, and we've got strong criteria about what's ethical, and so you can see the funds like KiwiSaver, who are on the chat last week, Booster, who's on next week, Simplicity, and other funds, and you can set your criteria on the website to see what's important to you. So it helps you compare across sites. Certainly Simplicity is one of the popular ones on the site. So well done, Andrew, and well done for your performance as Chief Investment Officer. You guys are not only running an ethical and not-for-profit model, but you're doing it in a way that earns very good financial returns. So that's a pretty great balancing act. So thank you very much for coming on. For everyone online, we're back 4 p.m. Thursday next week with David Beattie. David's Chief Investment Officer for Booster. And Booster's got ethical funds, so he's going to be coming to talk about some of the key issues that they see. He's going to talk about diversifying a bit into non-financial market investments, and he's going to talk about a bit more about fossil fuels. If you want information on these things, please go to Mindful Money's website, www.mindfulmoney.nz, and sign up to the newsletter, because then we'll give you all of the links to seminars like this and other things that we've got going on. So thank you again, everyone, for coming online, and thank you particularly for Andrew Lance for his input. Have a wonderful day. Kia kaha.
Thank you.
Thanks.